Let's talk to Craig Erlam. He's the Senior Market Analyst at OANDA. Very good morning to you, young Craig.
Good morning.
Right, we are going to talk about your favourite subject, cable, the Great British Pound against the US dollar, Bank of England tomorrow. It's a one-way ticket short term. Just to recap, we had Namur and the likes beginning of the year calling up to 148, crowded along, and then basically we had a triple top breakout to the upside, fail, rejection, double top, sell signal, onward and downward. Is it going lower?
I mean, I don't know if I've got anything left to say on top of that. You've summed it up pretty much perfectly well. It was a very overcrowded trade, and it seemed like a lot was being priced in and maybe a little bit ahead of itself. The Bank of England was clearly very keen to raise interest rates in May. Up until a few weeks ago, the economic data has very much turned against it. I think we may have discussed this currency pair last week, so we're really just building on what we've already said, really. The three figures we had last week was the PMIs. We had the construction PMI, which was weaker than we were expecting. Yep. The construction was slightly better, but still weaker than we were seeing previously. The manufacturing was weaker than we were expecting, and the services were weaker than we were expecting. So what this means is the surveys can be quite volatile, but coming on the back of a weak GDP figure, 0.1% for the first quarter, some other weak economic data, and also some dovish comments.
Car sales.
All of them. We've seen there's been a bad month really for UK data, and then on top of Mark Carney as well, claiming that it's not a particularly relevant which meeting they raise rates in, as long as they do it. So really pushing it back, kicking the can down the road, as it were. And laying the foundations for a no move in May, which is very much against what they were doing previously. Previously, we were priced in around 70% for a rate hike in May, and now we're down to 13%. That really shows you the way the market's gone. And while I haven't brought the chart with me, you can very much see what is moving this currency pair right now. There's multiple things that have moved it in recent months. Leading up to the last rate hike from 0.25 to 0.5, you can see a very clear correlation with interest rate expectations. Following that, the pair has continued to rally, despite the fact that interest rate expectations did stabilise in that time. But that was around the time that we were getting a deal on the moving on to the next phase of Brexit, talk of transition, talk of a Northern Ireland border, talks going well. So this is lifting cable in very much the same way as the initial vote hit it quite hard. But in the last few weeks, there's a very clear correlation between rate hike expectations and this pair. And now, with expectations having fallen so low for this meeting, this has fallen very much with it. But it's broken some very big technical levels in the meantime. We have broken through the neckline around 137. I remember highlighting on the previous show, 135, 134 could be an interesting support level because we've got the 200 and 233-day simple moving average band. Long term, 200 band in particular is watched quite heavily in the markets. So the fact that we are seeing that stabilise around here doesn't really surprise me. It doesn't concern me either.
Right.
We can see from the momentum indicators that this is holding up around this level. When the Bank of England does make an announcement tomorrow, I imagine it's come out on the hawkish side, simply because it's not raised interest rates, so people always question their credibility when they lay the foundations for something and don't follow through.
Yep.
So it will want to come out, I imagine, on the relatively hawkish side, talk up the fact that a rate hike will come over the next 3 to 6 months, and it's not entirely important when, but it is still coming. That could lift the pound, so we could see a little bit of profit taken on some of these short positions. In the longer term, right now, I still think this looks quite bearish because we've seen the break of that double top neckline, but that doesn't mean we can't see a correction. Initial resistance or initial test to the upside comes around that 137 again, the neckline, support turning resistance. Beyond that, I'd keep a close eye on the fib level should we see that move to the upside. But I think at the moment, with the data still quite weak, I think people are more turning their attentions to November as opposed to August, but obviously August being the next inflation report, naturally, that's always going to be the next one we're going to focus on. But if the data continues to be weak over the next month or so, I'd expect that to be bad for sterling because that, again, delays that next rate hike, even if, whether in reality, November, August, May, it doesn't actually make a huge amount of difference. In reality, what that does for longer term interest rates does, and that is what is now being seen very much in the charts right now, and what could continue to weigh on the pound, particularly against the dollar, which it doesn't matter where you look right now. The Australian dollar, the Canadian dollar, the euro, the yen, none of these are doing very well against the dollar right now because people are starting to think of a fourth rate hike in the US. So none of this looks good for cable in the medium term, but in the short term, don't be surprised if we do see that little bit of upside.
Maybe just basically looking to sell into strength effectively.
There is potential for that, but of course, as always with these things, it's all about the levels. So
But the textbooks would say you should have a return to the neckline on the double top, right? On light volume before you basically go south again.
It's always good to see a rotation off the neckline. That's confirmation of the initial breakup. But what you can see quite often is it actually goes back more towards the 50 fib level, the 38.2 or the 61.8. So that could even take us back as high as 140, for example. Just because we hit these 140, that's not necessarily a bullish signal. 140 also coincides quite nicely with the 55.89 moving averages, as well as, I can imagine looking at this chart right now, probably around the 50 fibs. So if we do move back towards those levels, that doesn't mean it's all of a sudden bullish again.
So where does it turn bullish?
For me, it turns bullish if it goes above the... Initially, again, you're always looking for confirmations one after the other.
Yeah.
It starts to turn bullish for me above the 61.8 fib, because that suggests that the bearishness which initially dragged it below the neckline isn't quite as strong as it first appeared. Then it's always above the high. The high is always the next giveaway. You could look at the 78.6 fib as well for further evidence, but for me, you're looking for previous lows to be taken out, which falls around the 50 fib on this occasion as well, around the 140 level. Key psychological levels, again, the 140 is that. The previous high is that final confirmation that this is done.
On that note, young Craig, thank you very much indeed.
Thank you.